Good morning and welcome to Multitude's 9 months 2024 results earnings call. I'm Lasse Mäkelä, Chief Strategy and IR Officer of Multitude Group, and I will be your host during this call. Today we will be hearing a presentation regarding our 9 months 2024 results by our CEO, Jorma Jokela, CFO Bernd Ecker, and the CEO of Multitude Bank, Antti Kumpulainen. Afterwards, there will be a question and answer session. When the Q&A session starts, you can raise questions via the Q&A section at the bottom of your screen or via audio line by raising your hand with the hand button at the bottom of your screen. I would like to hand over to our CEO, Jorma Jokela. Go ahead, Jorma.
Thanks, Lasse, and I hope everybody hear me well. So, hello everyone, on behalf of myself as well. So, my name is Jorma Jokela. I'm the founder and CEO of the Multitude. And today, I will walk you through Multitude's preliminary results for the first 9 months of 2024 and share some excitement, development, and news. Joining me are my colleagues, our CFO, Mr. Bernd Ecker, and our bank CEO, Mr. Antti Kumpulainen. Good, but what amazing year we have had it. So today we have a lot of great news to share with you. Our goal is to leave for you the 6 key takeaways. I know it's quite many, but hope we all survive them. So the first one, we achieved a strong 15% growth in revenue. Second, we deliver an impressive EBIT growth over 42%, driven by improvement in credit loss. Third, we successfully complete a strategy investment in Lea Bank. And fourth, me as a founder will focus the more strategy project on Future, and Antti Kumpulainen appointed as a new CEO of the Multitude. And fifth, we are confirming our EBIT guidance of 67.5 million euro for this year and turning our focus to achieving a net profit of 23 million euros in next year, 2025, and 30 million euro in 2026. And lastly, we launch new share buyback program. So lots of good news. But before we dive in this year performance, I would like to briefly remind everyone who we are, where we come, and where we are headed. We have impressive nearly 20-year track record as a profitable global FinTech company focused on serving the customers, often overlooked by traditional banks. Deliver outstanding and fully digital customer experience. We originating in Finland, in Scandinavian, and now operate in the full EU-wide banking license and listed in Frankfurt Stock Exchange in the Prime Standard. Multitude people's inspiration comes from our vision to change the world, to build the most valuable financial platform, give amazing experience for customers who are often overlooked by other banks. We want to democratize financial service through digitalization, making them fast, easy, and green. Our FinTech growth platform is built around the idea that Multitude serves as a core platform hosting all scalable components. And currently we have 3 business units on the platform. Ferratum, specializing in digital consumer banking, CapitalBox, focused in digital SME banking, and wholesale banking customers under the Multitude Bank brand. On the Multitude platform, our focus is twofold, enhancing scalability and constantly looking to new opportunities. We are a unique FinTech company, guided by ESG principles, contributing to growth and profitable since day one. We have a strong confidence in our business model, which has consistently enabled us to meet our profit targets year after year, along with commitment to high dividend payout ratio. And finally, we are excited to share our dream to building the company valued at 1 billion euro by end of 2028. All right, let's dive into our performance in the first 9 months. So it has been an outstanding year with a strong revenue growth over 15% and impressive EBIT growth at more than 42%. Although we faced a higher credit loss earlier in the year, those have normalized thanks to our skilled team and robust business model. Each of our 3 business units It's a different stage in their life cycle, and all are delivering the remarkable revenue growth. The current market environment is also very favorable for us. Credit demand and payment behaviors remain strong. New customer segments are entering in the market, and our total addressable market continue to expand as traditional banks struggle to meet customer needs. This year, we also complete our first share buyback program and are advancing our headquarter relocation to Switzerland. Looking ahead, we have clear priorities. First, we are committed to deliver profitable growth through three main drivers: organic growth, partnership, and acquisitions. Second, we are focused on enhancing scalability by investing in the risk and AI. The third, we confirm our EBIT guidance for this year, and we are ready to announce our coming year net profit guidance, 23 million euros in 2025. Good. But let's take a closer look at the Ferratum business. Revenue grew by 8.3% and EBIT by extraordinary 44.6%. This year, we focus on four key areas: improving the credit risk, integrating the Sweep mobile bank app for customers in Finland and Latvia, optimizing our digital marketing, and building up our partnership network. All four initiatives have been highly successful. Credit loss have improved significantly, which Bernd will present later. The Sweep app integrating is complete, and we will continue optimizing it. Our digital marketing efforts have doubled our return on advertising spend, ROAS, which is an outstanding result. And lastly, we are excited to announce our first embedded finance partnership in Poland, expanding both our distribution network and market presence. This partnership allows seamlessly integrate between our system, enabling our partners to offer financial solutions directly to their end users. Looking forward, we plan to scale Sweep mobile bank app to Ferratum customers in other countries. We will continue driving profitable growth through organic expansion, partnership, and acquisitions, while enhancing scalability through automation, data and AI, and risk management investment. With total addressable market of 24.9 billion euros and our current 2.3% share of that one, leave us lots of growth potential ahead. We are also confident about exceeding Ferratum's original EBIT target for this year. But let's dive into CapitalBox. So this year, we focused on accelerating growth, resulting in a 44.6% revenue increase. EBIT was minus 2.7 million euros due to higher credit loss reservation, mainly from the strong portfolio growth and lower recoveries in some industries at the beginning of the year. Our team made excellent adjustment to collection, underwriting, and risk parameters, which lead to strong improvement by Q3. We expanded sales channels, improved customer retention, boosted digital marketing, and scaled our secure lending product. In early 2024, we completed the acquisition of OmniBeta, a digital factoring company based in Denmark. Through the year, we have leveraged our AI and data expertise to enhance customer experience and efficiency. We see a huge opportunity in digitalization SME banking with a target market 14.8 billion euros, and we hold just a 1% share of that. Looking ahead, we will focus on integrating Sweep mobile bank account and credit card into CapitalBox offering and customers, driving growth through organic sales, partnership, and acquisitions. And we also enhance profitability through automatization, data and AI, and risk management investment. Our initial goal for 2024 was 10 million euro EBIT, but we are accepting the lower EBIT to take advantage of strong growth opportunities, backed by, of course, the group strong profitability. Good. Let's look at our newest business unit, the wholesale banking. The first year has been incredibly strong, with the revenue and lending portfolio growing over 170% year over year, generating 4.5 million euro EBIT by end of Q3. Our business unit CEO, Alain Nudecker, he joined in the Q2 on the team and has been expanding our specialized team from 4 people to 15 people during this year, and we continue investment this further. We have focused on building the high-quality customer pipeline of our secure debt and the payment solution product through the targeting marketing. We have also strengthened our operational and risk management process blended in AI and data insight. And today, our team is working with the client in 7 countries, focusing on both product, payment platform, and secure debt. This year, we successfully onboarded 2 major customers on our payment platform and over 100 million euro in secure debt clients. Both products now have a strong pipeline of the new customers. Looking ahead, the wholesale banking team is focused on accelerating customer intake, implementing a smart and disciplined underwriting process, and enhancing scalability through automatization, data and AI, and risk innovation and investment. We are confident in our ability to drive profitable growth with a strong risk focus, which is why we are confirming our goal to achieving over 6 million euro EBIT in this year. Good. As a part of our ESG program, we have set the goal for each area to achieving by 2025. This year, we have worked hard to strengthen our ESG effort and made the great progress. In the last quarter, we focused on enhancing our materiality assessment across the entire value chain, upper and the lower downstream, and assessing the key risk impacting as a part of our CSRD readiness goal for end of this year. Our key ESG metrics are tracked to meet our targets. This year has been especially busy for us and our shareholders, with our registered seat moving from Finland to Switzerland. Naturally, we have received many questions from shareholders about the reason for this change and the additional shareholder meetings. This slide provides an overview of what happened and what's still ahead. To give us some context, we had 3 main reasons for this move. First, we want to bring company closer to our investors. Second, we need to simplify the process for foreign shareholders to participation in our shareholder meetings. And the third, we wanted to open up investment opportunity for Finnish shareholders to invest in Multitude shares. We are not planning to relocate people or change our tax resident. Our aim is to keep the things that as they are with minimal disruption. We started planning this process over 2 years ago. Early on, we learned that the direct move from Finland to Switzerland was not supported by local legislation. So we need to do an interim step in the country that allows the transfer. We chose Malta as at that step, transferring the company to Malta first and then to Switzerland. Additionally, we had to change our legal form from European SE to public limited company and update our article of association to meet the local requirements. We also need to complete 2 annual closing over a year, first in Finland in June, and then again in Switzerland in coming December. Although this process has required 4 shareholder meetings so far, with the 5th meeting planned for December. And normally we would have just 1 meeting a year, so it's certainly been an intensive period. However, the process has been well managed and things should normalize next year once the final transfer is complete by year end. Good. About Lea Bank, our M&A team has been executing our acquisition plan, successfully closing at 18.6% strategy investment in Lea Bank. This investment aligned well with Multitude products, which fully complementary each other. We see this investment from 2 perspectives. First, from pure investment standpoint, Lea Bank is a well-managed listed company with a full automated and digital customer process, strong profitability and cost-income ratio with significant market potential. In our view, their share price is also considerably undervalued. Second, we see the many attractive opportunities for cooperation, just a payment platform, cross-selling products, and boosting profitability through the shared activities. We respect that the Lea Bank is independent, so any collaboration will be pure, transparent, and arm's length. We are excited about this opportunity to increase shareholder value for the both companies through this strategy partnership. The Lea Bank, they offer the lending products mainly in Scandinavian and addition the deposit product in Central Europe. We understand they are currently transferring the banking license operation and listing from Norway to Sweden, which may temporarily impact profitability. However, we see the strong benefits in this move and believe those advantages will soon be evidence to broader investor community as well. Good. This is my last slide, and I need to chip the water before that one. But maybe this is the most important slide for myself on today. So I founded Multitude about 20 years ago with a few colleagues. And since then, I have had the honor of leading the company as CEO. And in the early days, I focused on building our product, improving the customer experience, automatization of the process. And I also spent a lot of time working closely with our team, discussing how we could growth and innovate. This hands-on approach has allowed me to share my experience across the organization, helping colleagues overcome challenges and bring the new ideas forward, something I have truly enjoyed. Over the years, Multitude has grown significantly. We have expanded our country network, our team, and our product, growing from small startup to company with over 700 people serving customers in multiple countries across 3 customer segments. We have hit a key milestones along the way, like a banking license in 2012, going public in 2015, and scaling effectively after COVID. But this growth has also added complexity to our management and governance, with the rising regulatory requirement taking more and more my time. Because of those demands, I have had less time over the past year to focus on what I'm mostly passionate about: business and strategy development, mentoring, and product innovation. In November 2023, we launched a bold new strategy with a dream to reach a €1 billion market value by end of 2028. We have outlined the 3 drivers for this: organic growth, partnership, and acquisition, which will need the more and more CEO focus as well, especially at on the later 2 as they are the new things for us. After careful thought, I have a proposal last week to the board that I step down as a CEO by year end to focus on full-time a new role, the founder and strategy projects. In this role, I will drive the strategy initiative, mentor our top talent, building the partnership, and leading acquisitions. I would also continue the board of Multitude PLC and Multitude Bank PLC to drive our strategy direction. For my successor, I respectfully recommend to the Multitude board that Mr. Antti Kumpulainen, CEO of subsidiary Multitude Bank, also served as the CEO of Multitude. And as Ari Tiukkanen, our chairman of the Multitude Group Board, said last weekly, that he is confident that Antti's deep knowledge of our company, his strong performance over the years, and his experience as CEO of Multitude Bank make him the right leader to guide us in the next phase. I have personally worked closely with Antti many years now, and I know we share the same Multitude values and vision, and I am 100% confident this transition will go smoothly. And I have to say personally that I'm very excited about this change. I'm really, really excited about that one. And as it's allowed for me to focus fully on the value creation and dedicate all my energy to strategy project. Antti and I, we have agreed that we will jointly lead our full year earnings call in Q1 of the next year. And after that, I will remain available for investors and stakeholders as needed. We'll also be meeting many investors in the next 2 weeks as we are in the roadshow. And I really look forward to connecting with you all. And maybe Antti, you could say some words from here as well.
Thank you. Thank you, Jorma, for your kind words and trust given to me from yourself and also from the board of directors to start in the CEO position of Multitude. Hello all, my name is Antti Kumpulainen and I've been working now 9 years in Multitude and I work as CEO of Multitude Bank. I'm really excited to take on this opportunity to work as the CEO. I share the same vision and values with Jorma and the rest of the leadership team, and I expect the transition to be smooth, and we will continue working together towards our common goal to be a 1 billion valued company. Having said this, I am not Jorma, and my leadership style is different from Jorma's style. Still, the company vision and goals remains the same. As the CEO of Multitude, I will continue focusing on 4 major areas. Leading by data, I will prioritize data-driven decision-making to make our operations more efficient and responsive, driving both operational excellence and responsible growth. Accelerating digitalization, I am committed in digitalizing our operations to improve efficiency and reduce costs, while also minimizing our environmental footprint. Enhancing customer experience, creating an outstanding customer experience is really central to our growth strategy. By focusing on transparency, responsiveness, and ethical practices, we aim to build trust and loyalty among our customers who value responsible business practices. And the 4th one is improving the cost-to-income ratio. I am focused on improving our cost-to-income ratio by optimizing processes and using resources efficiently. By implementing targeted improvements, we enhance profitability while supporting sustainability, ensuring strong returns for our investors. I hope that I can meet many of you investors during our next week roadshow. And should we not have a chance to meet in the next coming weeks, I hope I will meet you in the near future. Thank you.
Good. Thanks, Antti. And now I want to hand over to Bernd for the 9 months financial performance deep diving. Go ahead, Bernd.
Good. Thank you very much, Jorma. Good morning to you all. I will maybe have a less exciting topic than we just had, but still I think our 9-month numbers, our 9-month result is pretty exciting. So it is definitely worthwhile staying in a call and listening to my presentation as well for a couple of minutes at least. What I will do is I will present to you the financial performance, obviously for the last 3 quarters. We'll deep dive a little bit into financial balance sheet metrics. And then there are 2 topics that we normally don't have on the agenda. That is a deep dive on credit loss development during 2024. Those who have attended the Q1 results presentation will have noticed that we were not 1% happy with credit loss performance. So we thought it would be fair and interesting for all of you to do a deep dive on credit loss performance over the last 9 months. And secondly, capital market guidance. I will elaborate a bit on the historic performance, where we are, what our expectations back then were, and how we, from today's perspective, see the upcoming 2 years. Let's start with P&L. I think I have 2 key messages that I would like to bring across. Number 1, the financial performance 9 months is characterized by strong growth dynamic. Essentially, this is a continuation of the H1 dynamics, so quite positive. Secondly, the actions taken to improve credit risk, credit losses, credit risk performance are yielding really strong results. So these are the 2 key messages I want to bring across. When we take a deeper look into the key performance metrics, starting with interest income, a very significant increase, plus 25.5 million to almost 194 million. That's an increase of more than 15%. The composition of top line growth looks so that 8.3% growth in consumer banking, 45% almost, 44.6 to be precise, in SME banking, and a really remarkable increase in top line development of the wholesale banking business of 170%. Net interest income. In order to talk about net interest income, it is inevitable to have a look at interest expenses. They have increased throughout the year. 9-month level, we are now at 30 million, or 27 million adjusting for one-offs, which compares to 14.2 million 9 months last year. There are essentially 4 drivers. One is higher reference rates, especially beginning first half of 23, we've seen reference rates being in the range between 2, gradually going up in the direction of 3, but on average for the full year, significantly lower reference rates, which have an impact on funding costs in 24. Of course, secondly, expiring of relatively cost-efficient term deposits during this period. Thirdly, which is a positive message per se, but has an impact on funding cost, we now have a significantly higher business volume. So business portfolio loans, investments have increased by more than 110 million compared to the same period 23, and hence the volume that needs to be funded has increased significantly, driving funding cost up. And finally, we have some 3 million one-offs in 24 expenses related to the replacement of the old bond, core premium for replacement, accelerated write-offs, so non-cash events as well, plus some 200K also related to the bondholder consent as a consequence of the relocation of the registered seat out of Finland. So factoring in these one-offs gets us to 27 million. This is pretty much in line with our expectation for the first 9 months of this year. Nonetheless, the ambition obviously is to bring funding costs down going forward. All of that growth and financial expenses result in net interest income of close to 164 million for 9 months, which compares to 154.3 million last year. That's an increase of almost 10 million, an increase of 9.5 to be precise, or plus 6.2%. After hedging cost and FX results, 1.2 million lower than last year, which is a positive contribution to profitability. And after other income, this results in a net operating income of 161.4 million, plus almost 10.8 million, or 7.1%. Let us move on in the P&L and focus on operational expenses and expenses incurred from credit losses. And as the topic of credit loss was a focus area, also related to the questions that investors have raised, I would like to start with a deep dive, taking a deeper look into credit losses first, to set the scene a bit. 73.6 million credit losses first 9 months. This is 14.3 million or 9.2 million above last year. But what is extremely important to understand from our perspective, at least, is the trend. So where are we in comparison to Q1? How does the trend look like compared to last year? For that, I would suggest that we briefly go to a separate slide reflecting credit loss development 23 compared to 24. And to recap the credit loss performance beginning of last year, we had some 28.3, this year, 28.3 million credit losses first quarter, which was, let's face it, not the target level, and is also significantly above 23 level. You can see that on the left-hand side of this chart. The drivers behind that were higher growth dynamics, also exceptionally low credit losses in the beginning of 23, I have to add. And finally, loan quality was not on an expected level in a limited but still number of markets, both geographically but also industry specific when we talk about CapitalBox, for instance. Now, from Q1 onwards, business teams and risk teams have put a lot of effort and emphasis to reduce credit losses. We've seen a strong impact already in Q2, credit losses going down by 4.5 million compared to Q1 to 23.8. This is a quite remarkable reduction of almost 16% in one quarter already. And during Q3, this positive trend, as you can see on this chart, has continued. So Q3, 21.5 million, almost 7 million less credit or lower credit loss levels than in Q1. And this actually means that Q3 credit losses consolidated are below Q3 levels 23. Sorry. The key drivers behind these substantial improvements are as follows. In consumer banking, integration of new data sources, refined underwriting models. Those of you who know us better know that we have a data science and modeling team of more than 10 people who do nothing but refining, recalibrating, formulating new hypotheses on descriptive power of all sources of data for the underwriting quality. and that has really helped significantly to reduce probability of default and increase the asset quality. On top of that, in consumer banking, we've seen a lot of operational improvements in all areas: payment processing, payment process related to customer interaction, as well as collection processes. Similar pattern in SME banking. You will see that also here we have reduced credit losses by 1/3 within the last quarter, despite the fact that portfolios increased significantly. So even more so is this trend very remarkable and positive. The drivers for SME are the proportion of secured businesses going up. Now we're in the region of some 20 million, 13-14% percentage, with an increasing trend. We've actively underweighted industries that were are affected by a challenging current economic environment, which has had a positive impact on credit losses. Also here we have increased and improved the collection efforts and processes significantly. I will not go into detail, but a lot of actions taken. And finally, also in SME business, refined scoring models have reduced, essentially probability of default by a couple of percentage points, also reflected in lower credit losses. And that's the key message on credit losses. We've achieved remarkable improvements of risk KPIs during the year 24. Good. After this deep dive, Lasse, I would like to ask you to go back to the P&L just for a second. I will be brief on the rest of the P&L. Personnel expenses up 2.3 million compared to last year. This is essentially the same level as H1, actually increased lower than in H1. The key drivers here are business. So in the end, it's about the new business added to CapitalBox, the OmniVeta factoring business in the SME space, and in the new business unit, wholesale banking, naturally, in order to enable this 170% increase of top line, we need to build up resources to make sure that we manage that properly. Almost all of the personnel expense increase is offset by lower depreciation expenses. In terms of general and admin expenses, with an increase of around about 3 million, a number of drivers. That has to do with relocation, of course, but also with a number of strategic initiatives, projects, M&A transactions. Also the additional audit process that we needed to complete for the consolidated financials H1 as part of the relocation out of Finland. But the big picture in terms of cost management is that we are managing cost pressure well. There is a lot of investment in future growth, and the objective overall is to achieve efficiency gains that kind of soak up, that compensate for cost increases. Now let us look at how these developments in revenue, financial expenses, OPEX and credit losses are reflected in financial performance. EBIT up to 47.2 million. This is a 9-month all-time high. And by the way, it's also a full year, or would be a full year all-time high already now. This is an increase of 42.2%. Profit before tax, similar level to 9 months last year, 14.6. Lower tax expenses, 1.9 million. That is equivalent to an effective tax rate of 13%, roughly. That's the target range, 13 to 14%. And finally, net profit, 12.7, slightly above 9 months 23 level. And this is essentially equivalent, if we adjust for the 3 million one-off that I referred to earlier, of 15.7 net profit. Let's on the next page have a very short look on assets. Actually, I think we can, or we should spend only 30 seconds on that. The two key drivers in terms of asset growth. That is on the one hand, essentially one, that is the increase in loan portfolio and also investments. So whether we call it or refer to it as 201 doesn't make much of a difference. This is the driver, more than 100 million compared to last year at the same time. Cash balance enables us to actually accelerate growth also during Q4. Next page, balance sheet, equity and liabilities. You are familiar with that already. We have issued a new debt capital market instrument. This is reflected in this balance sheet, larger instrument at lower cost. Deposit base increased logically with the increase in business volume. Equity stands at close to 188 million, and that is equivalent to net equity ratio of more than 23%, so very solid. Let us finally take a look at segment performance. I've covered a lot of topics already, so we'll not repeat too much, especially about credit losses. Let me kick off, please, with Ferratum, the consumer banking business. In short, same message as H1. Still a relatively high growth, 8.3% compared to last year. A very scalable operating model, significant improvement in terms of credit losses, 6 million, almost 6 million Q3 in comparison to Q1. Really outstanding performance. Not much to add. This results in very high revenue of 460.6 million, EBIT up to 45.2 million. It's an increase of 45%, so really excellent performance. Profit before tax, more than 23 million. So really, really top performance in my view. I would like to continue briefly with CapitalBox. As also in the H1 presentation, we're super happy with top line performance, revenue growth, 45%, really strong, up to 24.7. So I think it's not, don't take it as a guidance, but it would not surprise me if we would achieve all-time high revenue in CapitalBox for the year 24. Credit losses turnaround. There's no need to repeat what I've explained already, but reduced by 1/3 over the last quarter. So really good. Naturally, this remains a focus area also going forward. Cost, naturally with almost 50% revenue increase, this requires some increase in resources, personal expenses up by 1.6 million, which I think is quite moderate. This has above all to do with the team that we've taken over from Omniveta. General and admin expenses also up by 1.8 million, but we are looking at that as an investment to keep the growth engine running. As a consequence of that, EBIT negative at 2.7, but clearly the expectation is to see break even very soon and to see a significant positive profit contribution going forward. And based on today's data, the improvement in credit losses, the relatively low increase in cost, we think this is absolutely doable and realistic. Finally, wholesale banking, what can I say? Growth factor 2.7 from 23, 3.2 million up to 8.7 million. So excellent top line performance. Credit loss, no issues whatsoever. A fully collateralized business, no payment issues. So that's all good. It is an early stage business, so naturally personal expenses, operational expenses are increasing by 1.3 million. Slightly above 50%, but again, that is required to build up the resources, the knowledge, to make sure that this business runs smoothly and produces profit, and it does. So we are at an EBIT level of 4.5 million already. Jorma has indicated in the H1 presentation that we expect EBIT contribution from this business of 6 million, and based on these numbers, without promising too much, again, I think this is absolutely realistic, has achieved break even on a profit before tax level, so really top performance. On the next slide, asset quality. You are familiar with the trend, at least those who join us kindly frequently to our earnings calls. Clear downward trend, especially Q3 and Q2. Q3 even more so, first time below 3%, so not much more to add, a really strong trend. Slide number 6 and 7, I would like to combine those on 6. Just a statement, cash is on the target level. Also factoring in the growth ambitions that we have. That is, I think, the key message on this slide. And on the funding slide, I would also like to emphasize that we are from a pure funding structure perspective in a comfortable position. No repayments upcoming over the next 3.5 years. We've issued a new instrument expiring in 3.5 years at 100 basis points lower cost than the previous one. Naturally, the ambition is to reduce weighted average cost of debt funding from around about 4.5% going forward. That is the plan. And finally, on my last slide, before I hand back to Jorma, I want to share our view and rationale on financial guidance. The current view on 24 is we are on track again to achieve our capital market guidance of 67.5 million EBIT. We expect EBIT to land somewhere in the range between 66.5 and 68.5. This is the target range. And this would essentially mean that we have achieved back to growth volume or revenue guidance for 21, 20 million EBIT guidance for 21, 30 million EBIT guidance for 22, 45 million EBIT guidance for 23, and 67.5 million EBIT guidance for 24. This is, in our understanding, at least quite a remarkable track record. You are familiar, and Jorma has also pointed this out. A year ago, during the Capital Markets Day, we have shifted focus from EBIT guidance to net profit, which definitely is, in our understanding, but also in our own interest, much more meaningful when it comes to financial performance. So net profit is the name of the game. And we have given a net profit guidance for 26 on that basis. Logic was to increase by factor 2.5 within 4 years from 12 million in 22 to 30 million net profit in 26. And now that we are finalizing our EBIT guidance cycle in 24, we want to issue also net profit guidance for 25, which is a gap that we want to fill, as there is no capital market guidance for 25 yet. And the logic for 25 guidance is as follows. We are aiming at a significant profit increase. And profit in this context means net profit. To put that into perspective, if we extrapolate the 9-month profit of 12.7 to full year, this would result in 16.9 million net profit for the full year 24. Putting that into perspective, or the 23 million guidance for 25 into perspective of this extrapolation, the implied net profit increase 25 to 24 would be almost 36%, 35.8 to be precise. And finally, we think that this 23 million net profit guidance fits very well and supports our 30 million guidance for 26, which we want to confirm. Good. With this outlook, I would like to hand back to you, Jorma.
Good. Thanks, Bernd. What amazing numbers. So I want to repeat a little bit my first slide. So we want to leave for you in the 6 key takeaways on today. And like you can see, we have lots of great and amazing news. The first, we achieved a strong 15% growth in revenue. Second, we delivered impressive EBIT growth over 42%, driven by improvement credit loss. Third, we successfully complete our strategy investment in Lea Bank. Fourth, me as a founder will focus more on the strategy project, and Mr. Antti Kumpulainen appointed as a new CEO of Multitude, effective in the 1st of January. And fifth, we confirm our this year guidance and the turning the focus on the achieving the next year guidance, 23 million euros, and 2026, 30 million euros as a net profit. And lastly, we will launch in the new share buyback program, what have decided on the yesterday evening on our board meeting. Good. And ending in that one, I think we are ready to ending our presentation and then ready to take all the questions.
Yeah. Thank you, all speakers. And as Jorma said, now we have time for Q&A. So for Q&A, you can raise the questions via the Q&A section at the bottom of the screen, what you have, or then via audio line by raising your hand. There is this hand button at the bottom of the screen. If you press that, we will pick you up to speak. But if you are asking via audio line, please speak clearly and slowly so that all the participants can hear you, the question. So let's open the floor for questions. Any questions yet?
At least in my Q&A box is empty, and rather it's good or bad news.
I think we
got it. The first question here. Maybe
yes.
Bernd, you can take that one. Do you, Lasse, want to read it loud or?
Or is it Frederick? Do you wanna ask that audio, or do you just?
I can take it right away and answer.
Okay.
If that is
Okay. Right.
Frederick Jakob, do you have already any visibility on Q4 credit losses? Because it looks like that financial year 24 EBIT guidance strongly depends on Q4 credit loss performance. Now, in terms of, let me start with credit losses and then elaborate very, very quickly on EBIT and our view. The credit loss performance, what we wanted to do is to present the trend. Now, naturally, the expectation is that we see, that we don't see elevated credit losses that we've seen earlier this year, so that this trend essentially continues or at least stabilizes on a relatively low level. That is the target. You will understand that it's not the time to give a specific guidance on credit losses, but this is naturally the ambition. And I have to say that the fact that credit losses have improved so significantly over the last 2 quarters is not driven by any one-offs related to transactions. There were some positive impacts from credit sales, from loan sales, but they are in the region of less than 1 million. So they are not the drivers. The driver here is structural, fundamental improvement of the underwriting, the collection processes, operational processes, really a hard fact and not one-offs. From that perspective, I'm optimistic that we see a good Q4 performance. Naturally, it's not realistic to assume that the linear trend will continue to go down forever. Having said that, on the guidance, I think there are more drivers than only credit losses. Credit losses is one. We need, in order to get exactly to 67.5 million, we need 20.3 million in Q4, which is 6.8 million or 6.77 million per month. That's realistically achievable. Naturally, what is more important for us than 67.5 versus 67 or 66.9 or 80 or 68, that's not so relevant in our view, to be super honest. What is relevant is that for 4 or 5 years now, we have demonstrated that we are able to increase EBIT profitability by 50% year after year. And this picture doesn't change, even if the year ends at 66.9. This is the key message that we want to bring across. And the key message that we want to bring across on top of that is that also on a net profit perspective, we are able to achieve a similar pattern. So increase from 12 million net profit in 22, gradually up to 30 million in 26. And this is, as I said, the logic behind the 23 million guidance for next year. And that definitely also requires high quality of underwriting, credit loss management, portfolio management of the whole team, business and risk management going forward as well.
Good. Then we have next question is coming from the Q&A box as unfortunately some reason there is no name, see the name or who is make this question, just read Anonymous. It's so it's Mr. or Mrs. Anonymous who make this question, and there is 2 questions. The first question is, could the company report the return on equity and return on asset of business unit, focus on the ROE and the ROAS, make a result comparable to other financial institution? That's the first question. The second one, you have stated have been undervalued. Should it be the logical to buy and cancel the lot of shares that will drive up earning per shares, net worth per shares, and dividends per shares? I think it's really great and good questions. Maybe Bernd, I can start to answer the first one, and then yes, you can add it there. So, of course, our internal metrics is that we look into return on asset and return on equity. A little bit depends the product, but our database, our business management model, our whole business concept is based that we look the return on asset and return on equity is a product channel base. So we go to very deep dive when we look into we want to understand the the Sweden customer and the consumer business in Sweden and this particular channel, we typically look into all our investment decisions are based in the very deep diving as a return on asset or return on equity base. Depends a little bit product, because the equity requirement is different. We have not really want to pin into lots of more like a wider opening that one. As so far we did not want to do in that one. But of course we are always happy to considering the different reporting opportunities. But so far it was not been the very in our agenda. Of course, the return on equity is a little bit challenge as well as a reporting point of view, because then you have to you have a one equity requirement package, and then you have to allocate at different things, and then of course the share resource it might complicate things. But maybe Bernd, do you want to comment on add anything on this first question?
No, I agree. I mean, return on assets is a simple exercise. All data is reported already. And of course we can, and I'm happy to do the calculation. That's not return on equity, as Jorma pointed out, it's a little bit more tricky, different regulatory regimes, allocation of equity, something that we would have to do.
We will think about
it and get,
exactly
and get back.
Exactly, good. And then the second one is about the question, the share buyback programs. And I think actually I want to remind that my comments about the undervalued shares was related to Lea Bank and not actually our own shares. I mean, I have tried to hold the CEO period, try to avoid the comments too much our own share price and leave it this for the shareholders. And I have tried to focus on the driving the business performance further. But I personally believe, and our team is believe, that the Lea Bank share value is undervalued, and that's one of the investment decisions behind why we want to do it that one. But of course, we think about, or I think about as personal now, that our share price is it's undervalued as well, and of course, a little bit indicate other people feel as well that we want to second share buyback program launching on this year, and definitely it's what we have done. Typical the first share buyback program shares what we bought, we have allocated lots of those shares on the matching share program, and our key people like a compensation package there. So we have tried to buy the shares from the market as we see it's undervalued, and allocated this for our key people as a part of the motivation package there through our matching share program. So happy to think about the cancellation, the share topic as well. It's but currently my personal view is try to driving the motivation there further. It's and that we can boost into the value creation there.
Good. I think we have one sort of audio question here from Adam Czercieski. Sorry, hopefully I answered that, said that correctly. But, please go ahead.
Yeah, thank you. Good morning, everyone. Adam speaking. First of all, congratulations on the performance so far and bringing cost of risk back on track, as I see from the results. And of course, congratulations to Antti for his new appointment. My point is more about the external factors. What are the, let's say, the most important attention points that you see right now or coming into force going forward if it comes to the potential impact on the business model and the performance? Do you see any type of significant, let's say, potential obstacles to be tackled or are being tackled by the company right now?
Maybe if Bernd, I will start and then you can add it, and of course, Antti, if you want as well. I personally believe that our management focus are lots of focus on those elements what Antti actually mentioned earlier. So So our challenges are coming on the how quickly we can utilize and even further automate it, and our decision process, and utilize the AI in the different part of the organization and improve our cost income ratio in that way. I personally believe that this is the very, very important topic for us in the future. And I have a personally used the example, the whole AI part. Is, I mean, of course, we have working with AI for many years, but topic have breakthrough very strongly over the last few years, because application is much more easier, and computing power is much more powerful, so you can really utilize the AI as well. So my personal view is that one, that this transition, what's happened on the automated on the different process, is extremely big. It's like a comparison, but the back to 1980 when the personal computer was coming, and changed the people way to working. And now my personal view is that the whole AI has changed the people way to working, and that's the reason why we have done the many years already lots of investment in this part. Like you see in our presentation, example, the marketing part. We have doing lots of our data team have working with the marketing team how we can utilize AI better. Lately, we public on the now in the first time actually. And today we public in our CapitalBox. We actually have with our data and AI team have working with CapitalBox and our OmniVeta team, the factoring team, and how we can find the way to doing the invoice tracking the better. They're really automated the things further, because there is lots of data and there is lots of tools to utilize that one. And so I personally see that this part it's a optical same time when it's opportunity. And the reason is that if you are not the forerunner there, you will lose the competition there. And that's my personal view. And that's the reason why we take this super serious as a part of our management, the all decision and investments. Yeah, that's maybe the one of the big things. It's what I will say. But I don't know, the Bernd, Antti, do you want to add it? I mean, of course, I can list the lots of challenges what company can facing. It's I don't want to say that one, but Bernd, Antti, do you want to add it something?
Just one sentence. As external attention points can be positive and negative. I would see some positive ones. That is, I think we've really managed well to reduce credit losses, to repeat the message, in an economically challenging environment, both for consumers with all the inflation pressure of the last 2 years, and also for SMEs with quite difficult economic circumstances. And with going forward, we would hope and expect to see improvement here, which I would see as an upside potential for us. And then secondly, market conditions. I don't know whether this goes in the direction of your question. Unorganic growth opportunities, also to, in a way, external factor or external from our internal perspective. This is also something that is going to be an attention point going forward.
Very clear. Thank you.
Thanks, Adam.
Good.
Okay, we have some question coming in the chat over this time as well. It's maybe we should take here the Peter Irlap. It's have it 2 questions. Bernd, do you want to take that one?
Yes, let me go back. Question number 1, what's the EBIT outlook for CapitalBox for 25? Will you be able to get to 10 million EBIT originally expected for 2024? I think I would want to give an answer that is more of directional nature than super specific or in the numerical sense. But the magnitude appears to be not far away from what we are looking at. In the end, we've seen close to break even in Q3 on an EBIT basis, which is a quite positive trend. Yes, we are maybe a couple of quarters late in the development, but the overall way of looking at it still makes sense. So don't, it's not a promise for the specific number, but the direction appears to be right. And then Peter raised another question. When you say you want to lower interest expenses, can you quantify?
And maybe Bernd, maybe we can combine this actually, the Frederick Jarshov, the next question as well, that is the peak in the interest expenses already reached, and it is fair to assume a decrease already within the next quarters? I think maybe those two questions we can combine there as an answer.
Yes, great questions. In a way, lower managed credit, deposit and funding costs so that we achieve the net profit guidance. Now it's not outside the guidance world or universe anymore. Now it goes right into the guidance metric. In terms of deposits, there are two trends. One is we see a reduction in interest rate levels for new deposits gradually, but here we are significantly lower in 36-month money, for instance. We were at 4.5 a year ago. Now we have around 3, even slightly below that. So that's a positive trend. We need to factor in that those higher priced interest rate levels are locked for 36 months, for instance. For somebody who has deposited 36-month money with us a year ago, that is going to be locked on this price level for another 2 years. So this will gradually melt down. So there's a time lag in the reduction compared to reference rates. So the question whether we see a peak, interest rate deposits, I think so, yes. But we need to also understand that we will need to, and this goes also in the direction of capital related question, and we will go to that in a minute. We also need to make sure that we have the capital to support growth, and capital can be tier 1 share capital, but it can also be tier 2, additional tier 1 type of instruments that are more expensive when it comes to interest rate levels than the deposits, obviously. Currently, we hardly have any tier 2 capital on the level of the bank. This is certainly something we need to change going forward. We need to make sure that the bank has also access to tier 2 capital to support the growth outside CET1. And so those are two offsetting factors. But on deposits, yes, I think we've seen the peak.
Yeah, exactly. And I think this question was partly answered as well. The Tobias Flake, he asked, I would like to raise the question of concerning capital. As a capital is a main restriction factor for the banking business to grow, how is your plan to increase capital enough for your ambition long-term growth target to be fulfillable? And like Bernd, I think you already mentioned, maybe I want to highlight there as one like a key driver from as a shareholder point of view as well. It's that management have a very strong focus to driving the profitable up to fulfill the capital requirement through the net earnings and the operative profit there as well. So that's the additional with what Bernd mentioned.
Yes.
Good. And I think there's still one additional question from Frederick.
Yes, there is one more question from Frederick, who is the embedded finance partner of Ferratum in Poland. Could you say something to revenue sharing model and quantify the potential or at least the expectation? We have not so far the public the partner name there, and not the structure there as well. Maybe we can just a general level to talk about on the embedded finance concept, how is typical working. It's or how we see it's a working. So we see it we see it on the way that we utilize the partner typical have access on the customers, so they have a rather some other business or some other access to way the large number of the consumers or SMEs, and then we as a multitude through the Ferratum or CapitalBox, we are integrate our technology on the way that this customer can through our system to selling our financial product to their own customers, and then the asset are sitting in our balance sheet, and the customers are in our customers, and then we have a kickback model, how we pay back for the destruction, and this a little bit depends, of course, the structure as well. Sometimes Sometimes we push the price a little bit lower and accept that there's no kickback because the value creation, the customer or the partner is so high, because of course the partner they can accelerate their own sales to have a fully integrated, fully embedded financial solution. So they can increase their own customer value proposition, and this will be actually increase their own sales. And some other case we have some type of the kickback, but the more common is that there is no even kickback behind, because any profit sharing, because our product is bring the more value for customers, the partners, to selling their own business there. So I promise that we will come back for this partnership topic, and I promise that 1st of January onward, when I have more time to spend that as personally, and Antti will be take more my roles, and that's the elements where I will bring to table more, and we will definitely open the concept on the publicly as well. But so far we have not want to open too much on the concept there.
Good. Do we start to be ready?
Yeah. Okay. I think we are ready.
Okay. Good, excellent. Do you, Jorma, still want to say some last words, or should we just conclude?
Thanks, Lasse. I think it's amazing year is behind. Like you can see that we have amazing performance to all our 3 business units. We have a lot of positive things happening. Of course, lots of challenges as well. I hope today this earnings call was open a little bit more for you. Our relocation or the registrar's office, the relocation as well, and bring the clarity for there as well. And I think me and our team, we are extremely excited for the further, and hope we will see lots of investors on the coming weeks. And let's push the things further. Really big thanks, everybody.
Great.
Thank you.
Thank you, everybody, for joining the call. And this concludes our call today. So thank you and goodbye.